So if stock price goes down, there's an inverse correlation between stock price and yield. It means the yield I can get in, the entry yield, is going to be higher. And so I hope this happens. I welcome this situation because sure, the capital appreciation, the value, net aggregate value of my portfolio will take a little bit of a hit, potentially. Maybe it hurts my ego a little bit. I don't mind it. Because at the end of the day, what I'm tracking is passive income because I can pay the bills with passive income. I can't pay the bills with capital appreciation because I'm not here to sell. I'm here to live off perpetual streams of income. Hey everyone, it's Ian. I'm back with another video about dividend growth investing. Today's video is a question that I received today. I received it on my Facebook fan page. And the reason I'm answering this one first is I want to build awareness that I have social media on the internet above and beyond YouTube. YouTube is really the core of my strategy right now about sharing and empowering folks in the financial space and the personal finance space. But I do want all of you to know that I also have a Facebook fan page, an Instagram page, a Twitter, and also a blog, ppcian.com. So if you want to be scrappy, you want to get in contact with me, and you want to ask questions about personal finance, of course, feel free to ask them in the comments below. I always look at those. I have a long queue of questions that I'm going to answer. But also, please feel free to go to any of my profiles across the internet and ask away. And so I wanted to give a little bit of priority to this question today because it came through Facebook, and this was one of the first people who have asked questions to me through my Facebook fan page, and I really appreciate that. So the question goes like this. Hey Ian, the Fed funds rate. Right now, the Federal Reserve Fed funds rate is set really low. This is the rate at which banks lend to each other, and because the rate is set really low, interest rates in general, it trickles down to everything, are really low right now. Interest rates for mortgages, interest rates on bonds, interest rates if one is to go out and take on debt, a loan for a business venture, for a small business venture. Interest rates are at historical lows. And the reason for this is coming out of the Great Recession, the Federal Reserve steadily cut interest rates. The Fed funds rate, they cut it to record lows. And it's now hovering around record lows. And the question goes like this. Hey Ian, where do you think the Fed funds rate is going to go over time, and how does that impact your dividend growth investing strategy? So this is a really good question. I love these economic thought exercises, and I got my notes, so let's go through them one by one. The first point that I want to bring up today is that I personally believe that the federal funds rate will stay low. It'll stay low for a while. Surely, as the economy continues to improve, we continue to climb out of the Great Recession, the Federal Reserve will want to make sure that inflation does not rear its ugly head, that inflation does not come around and devalue the value of the United States dollar. And when I speak about the US here, I'm also speaking, I would say, internationally as well, because international equivalents of the Federal Reserve have followed very similar patterns to slashing interest rates, and in some countries even going negative. And I think the United States is probably recovering quicker than some of the European countries based on the economic lessons that I've been following. But that being said, I do believe there's probably going to be a complete worldwide global recovery. And at that point, around the world, the federal funds rate equivalent in other countries will probably be affected as well. But my belief is that we're still in the middle stages of this recovery. Surely there are pockets of growth out there, especially in technology. There are pockets and microcosms within the world, cities, major metropolitan areas that have recovered. There are certain areas in the country that have not fully recovered yet. There are certain industries that have not fully recovered. I believe that the government and the people in power are monitoring this. And they're not just going to go flip the switch one night and say, hey, everything's better, let's just jump that Fed funds rate up by orders of magnitude. No, It's going to be a slow and steady process, in my opinion, when it does happen. When the rates start going up, and we're already seeing indications of this, it's likely to be baby steps, and it's likely to take many years to get back to where the Fed funds rate was. And at the end of the day, it's probably good to have a higher Fed funds rate, just from the standpoint that there is no free lunch. And with interest rates this low, it incentivizes certain practices, it incentivizes certain things that could have long-term repercussions. And so by getting things back to equilibrium, it's probably not a horrible thing for our country and for the world at large. Look, I'm not an economist here, but these are just things I have personally picked up by following world-renowned economists. Now, again though, the meta level point here is, look, we're talking about dividend growth investing. We're talking about investing in stocks for passive income and cash flow. And there's going to be some kind of relationship between valuation of stocks, especially dividend stocks, and that Fed funds rate. We'll talk about that more in a minute. But what I'm trying to illustrate here is, even if the Fed funds rate goes up over time, which it probably will, it's going to take years to get back to where it was. So it's all about baby steps. And that is very important as just an overlay to my strategy as it pertains to economic cycles. So let's just jump now into it. Why is this Fed funds rate so important for dividend stocks? Well, when one is deploying capital, has many options to deploy capital. They can put it in a savings account, high yield money market, bonds, stocks, dividend-paying stocks, multitude of other investments out there. I've even covered peer-to-peer lending here on my YouTube channel. Right now, there are very few options if one is an income investor. If one invests for dividends, cash flow, passive income, the interest rate right now on bonds, it's at record lows. Again, why? Because the Fed funds rate is really low right now. It trickles down to everything in the economy. And so, let's think about a savings account. You're not going to get much interest there. High yield savings account, I remember 10 plus years ago, these high yield savings accounts used to be a big thing. They used to be really, really exciting. They used to be able to get a reasonable interest rate, granted as ordinary income, but a reasonable interest rate on money. That is not the case anymore. And so an income-minded investor, there really aren't that many options right now, and one of the only options is dividend growth stocks or dividend-paying stocks. And so let's say over time that Fed funds rate climbs. What does this mean? It's going to trickle down to everything in the economy. Oh, suddenly I can get an interest rate on a money market again. Wait, you're telling me that money market has no risk associated with it, or minimal risk? Maybe I'm going to take my money out of dividend stocks and put it in that. I'm speaking hypothetically. I personally wouldn't do this, but I'm speaking hypothetically of the thought pattern of a hypothetical person out there in the world. And so when an investor has options versus no options right now other than dividend stocks, it changes the playing field. It changes things a bit. And the concern, if the Fed funds rate goes up, interest rates go up, suddenly there are alternatives to dividend-paying stocks. Money may come out of dividend stocks. It may push the share prices down and the yields higher. This is where it gets interesting. So this is the fundamental point, in fact. I invest for dividends and cash flow. I've spoken about this in my other YouTube videos, but if a share price goes down because people are pulling money out of the company, and the fundamentals of the company haven't changed. The fundamentals are fine. And in fact, in this case where the Fed funds rate is going up, it's likely a signal that the fundamentals on a macro level are reasonable, because otherwise the Federal Reserve wouldn't have the confidence to raise interest rates. But if they have the confidence to raise interest rates, it means the economy is great, which means that most of the macro level companies, speaking in aggregate, are doing pretty well. And so suddenly, if investors have options, they take money out of the very stocks that pay dividends. Potentially, the share prices could go down or they could stay flat. Who knows? In that case, it doesn't concern me, because I'm not in it for capital appreciation, which means buying low, selling high, because I never sell. Rarely sell, very rarely. And I'm in it for cash flow, and I'm still buying, I'm actively buying. And so if stock price goes down, there's an inverse correlation between stock price and yield. It means the yield I can get in, the entry yield, is going to be higher. And so I hope this happens. I welcome this situation because sure, the capital appreciation, the value, net aggregate value of my portfolio will take a little bit of a hit, potentially. Maybe it hurts my ego a little bit. I don't mind it. Because at the end of the day, what I'm tracking is passive income because I can pay the bills with passive income. I can't pay the bills with capital appreciation because I'm not here to sell. I'm here to live off perpetual streams of income. And so if anyone out there in the dividend community is scared about the Fed funds rate going up, the purpose of today's video is to challenge that thinking. It's to present a counter argument, to present a different way of looking at things, that this could be a very welcome thing for all of us. But again, keep in mind, to my original point, even if the Fed funds rate goes up, it's going to take time. And so I don't expect any immediate type of change overnight. Next point. The federal funds rate going up will likely impact different sectors of stocks differently. There are certain sectors of stocks, like utilities, for example, that have a very close relationship with interest rates. If interest rates are really high, investors have other options. They may pull money out of utilities and put it in those other options. If interest rates are really low, utilities are oftentimes a favorite with income investors because they're pretty stable, especially government-regulated utilities where the price of the energy is regulated by the local municipality or the state, and competition cannot come in because it's a regulated market. This is a very stable business model, and so a lot of income investors, pure play income investors who otherwise would be in bonds, go into utilities when bonds don't offer the yield that they want. I imagine that sector would get hit a little bit more aggressively, meaning the share prices would go down, versus another sector that shows more growth. Like let's say someone like, a good example, I just shared a video on how I own Kimberly-Clark, how I've been averaging in. And this is part of my new series about how I'm showing others how I personally analyze stocks. I imagine a company like a Kimberly-Clark, maybe it would be affected, probably not quite as much, because this is not only a dividend-paying stock, it's a growth stock, it's a dividend growth stock. And so when a stock has that element of growth in it, it makes it a little bit more immune to people just pulling money out because the Fed funds rate has gone up. There are certain sectors, mainly what I think about are utilities and potentially real estate investment trusts. Those are tied very closely to interest rates. Other sectors where it's more of a dividend growth brand style investment, they're not quite as tied to it, maybe a little, but they're a little bit more immune. And so the point here is, well, if one thinks that the Fed funds rate is going to go up a lot, one wants to get into a utility stock and a consumer non-cyclical stock, maybe wait on the utility a little bit. That's one potential route. That's one potential strategy. Or another point on here, dollar cost average. The beauty of dividend growth investing and dividend reinvestment plans and the whole philosophy behind all of this, even low cost brokers, is it becomes a lifestyle. One isn't just going to buy some stocks, hold on to them, and then all of a sudden be generating enough passive income to live off of. No. This takes decades to build, and it takes constant buying in the market, monthly, ongoing. And so if one has that mentality, hey, I'm constantly averaging into the market, I'm dollar cost averaging in, well, that's a great attitude, because regardless of what happens with the Fed funds rate, maybe there's going to be better valuations on stocks later. I think the main concern here is, hey, do I get in now or do I wait? Because if I get in now, what if the market goes down when the interest rates go up? It could. The fact of the matter is, if one's dollar cost averaging, they're hedging their bets. This is what I do all the time. I'm dipping my toes in the market all the time. I'm always averaging in. Sometimes I get a good price, sometimes not so good. It all averages out in my favor. It's been proven that dollar cost averaging is a great way for investors to mitigate market risk, market fluctuation risk. Now, a caveat on dollar cost averaging, if I were starting over and I were just literally putting my first 1,000, 5,000, 10,000, 25,000 in the market, I would probably not dollar cost average so much. Maybe I would a little bit over the course of a few months, but I wouldn't wait. I would just want to get that income snowball going. But let's say I had $500,000 to invest right now, cash. In that case, I would probably put in some of it up front, but then I would average it in over the course of a few years. And so that would mitigate my risk of putting the lump sum in at the top of the market, or potentially the top of the market. We just don't know. And so that's the beauty of dollar cost averaging. Something else that I really think is important here, I think a lot of people on my channel watch my videos and they wonder, Ian, why are you modeling so conservatively at 7%? We know the S&P has done 10% over time. We know, or at least I know, I consistently beat the S&P 500 time and time again. Why, Ian, do you model at 7%? The precise reason I model at 7% is, one, I want to adjust for inflation, which takes your S&P 10% down to 7%, but also I want to adjust for the fact that a recovery may, or a recession may be coming. We don't know. A correction may be coming. And so if the Fed funds rate goes up over time, it will happen towards the tail end of this economic recovery that we're experiencing now. Usually when that starts happening, the economy is good in the short run, but at a certain point, tides will change. At a certain point, another recession will hit. And so companies tend to be a little bit more conservative around that time in dividend increases. Companies' share prices tend to not go up quite as quickly because they've already gone up a lot. It's the market's starting to change. So for me, at this stage in the game, well, at any stage in the game really, but especially at this stage in the game, I model conservatively, and I challenge everyone out there to also model conservatively. So I really appreciate this question. I've covered a lot of ground today. Some of this stuff gets quite technical. The key takeaways, in my opinion, are these. I personally don't worry about the Fed funds rate on a day-to-day basis because I'm always averaging in. If the market tends to correct because the Fed funds rate goes up, especially dividend stocks get hit, I'm okay with that because I'm going to be able to average in at progressively better yields. And cycles will happen. There will be bull markets, there will be bear markets. I always try to select those stocks that will do well in any kind of economy, and I'm always buying because to get where I want to go, I've already been buying through multiple cycles, bull markets, bear markets, and I will continue to. It doesn't matter what the market is, I'm going to be buying. And so I've always got to be buying those stocks that, despite what's going on, will thrive. They'll do really well. So I thank you for that question. Thank you for bringing that to my Facebook fan page. If you do want to check me out on social media outside of YouTube, I'm going to link below to some of my pages on the internet, Twitter, Facebook, Instagram in particular, my blog as well. Feel free to stop by and say hi. I really appreciate it. Now, if you enjoyed the video today, I please ask you to give a thumbs up, to comment, to subscribe, all that good stuff. It's the greatest way that you can thank me for all of the hard work that I put here on YouTube. Before I leave, I want to give a full disclosure that I am long. I own Kimberly-Clark. I love that stock. I'll continue to own it for a long time, and I have already owned it for a long time. I'm always averaging in. And also, just as a disclaimer, I am not a licensed investment advisor. In today's video, it's not investment advice. My video is just for your fun and entertainment. And if you are going to go out and invest money in the stock market or anywhere else, please do consult a licensed financial advisor first. Thank you so much for watching. I will see you in the next PPC Ian Dividend Investing video.